The stock market is experiencing significant volatility due to recent policy changes, and many investors are panicking without understanding the real causes behind this market downturn. What if I told you this crash isn't random, but tied directly to specific political decisions that could reshape the global economy? In today's video, you're going to discover the 3 major triggers behind the current market crash, how historical trade wars have impacted economies in the past, why geopolitical tensions affect your investment portfolio, the surprising theory about why this market crash might be intentional, practical strategies to not just survive but potentially profit during this downturn, how to build a resilient investment portfolio that can weather any economic storm, the psychological mistakes most investors make during market crashes. Before we dive deeper, if you're serious about building wealth even during uncertain times like these, make sure to hit that subscribe button and ring the notification bell. This channel is dedicated to providing you with actionable financial insights without the hype or fear-mongering you'll find elsewhere. If you find value in today's analysis, smash that like button. It really helps the algorithm show this video to others who need this information right now. Let's get something straight. Market crashes aren't rare disasters. They're a normal part of the investment cycle. Historically, the US stock market experiences a correction of 10% or more, approximately once every 1.5 years. What makes the current situation unique is its direct connection to specific policy decisions. Understanding these connections isn't just academic, it's essential for making informed investment choices when others are panic selling. Market crashes typically fall into 3 categories. Corrections, 10 to 20% drop. These happen frequently and are generally healthy market adjustments. Bear markets, 20 to 40% drop. These occur every few years and last about 289 days on average. Full collapses, 40% plus drop. These are rare, but historically have been followed by substantial recoveries in the US. What we're experiencing now has the potential to move beyond a simple correction into bear market territory, depending on how certain policies unfold. Problem number 1. The trade war escalation. The current administration has implemented significant tariffs on foreign goods, particularly targeting major trading partners. In February 2025, a 10% tariff was placed on Canadian energy imports and a 25% tariff on other Canadian goods. When Canada retaliated with their own 25% tariff, the administration escalated by increasing tariffs on Canadian steel and aluminum to 50%. This mirrors the disastrous Smoot-Hawley Tariff Act of 1930, which many economists believe contributed to the Great Depression by triggering international trade retaliation. When countries engage in tariff wars, several negative consequences follow. Higher consumer prices as import costs rise, supply chain disruptions affecting production, reduced export opportunities as trading partners retaliate, job losses in export-dependent industries, formation of new trading alliances that exclude the US, like the expanding BRICS partnership. Solutions to navigating trade war impacts. Diversify investments across sectors with different trade war exposure. Consider increasing allocation to domestically focused companies that are less affected by international trade tensions. Look for opportunities in countries not directly involved in the trade disputes. Monitor developments in trade negotiations closely, as sudden resolutions can lead to rapid market recoveries. Consider investments in companies that may benefit from reshoring manufacturing. Remember, trade wars create winners and losers. Understanding which industries might actually benefit from protectionist policies can create unique investment opportunities. For example, domestic steel producers might see short-term benefits from tariffs on foreign steel imports. Now let's move on to another significant problem. This one affects global stability, and I want you to listen very carefully because it impacts markets in ways many investors completely overlook. Problem number 2. Geopolitical uncertainty and NATO relations. The administration has questioned the value of NATO and suggested that the US shouldn't defend allies unless they increase their defense spending. While this might sound like reasonable cost sharing, the potential destabilization of a 75-year security alliance creates massive uncertainty in global markets. Markets hate uncertainty more than bad news. When investors sense potential geopolitical instability, they often reduce exposure to risk assets, flee to safe havens like gold and US Treasury bonds, price and risk premiums across multiple sectors. If NATO weakens, it could embolden adversarial nations to become more aggressive, potentially leading to regional conflicts that disrupt global trade, energy supplies, and financial markets. Solutions to managing geopolitical risk. Build a strategic allocation to traditional safe haven assets like gold, which historically performs well during geopolitical tensions. Consider defense sector investments, which often see increased demand during periods of international tension. Diversify internationally, but with careful consideration of geopolitical exposures. Maintain adequate cash reserves to take advantage of short-term market overreactions to headlines. Look at countries with strong self-defense capabilities that may be seen as more stable during NATO uncertainty. I believe preparing for geopolitical turbulence isn't about panic, it's about positioning. Smart investors know that headlines often cause short-term volatility but rarely change long-term economic fundamentals. Problem number 3, the interest rate strategy. There's a fascinating theory circulating among economic analysts that the current market turbulence might actually be intentional, a strategy to force the Federal Reserve to lower interest rates. This isn't as far-fetched as it might sound initially. The administration has consistently criticized high interest rates, calling them ridiculous and harmful to economic growth. The Federal Reserve, while technically independent, responds to economic conditions. If the stock market crashes dramatically and recession seems imminent, the Fed would likely cut rates to stabilize the economy. But here's where it gets interesting. The US government currently carries approximately $36.5 trillion in debt. When interest rates are high, servicing this debt becomes extremely expensive. Every 1% increase in rates adds hundreds of billions in interest payments annually. Solutions to navigate the interest rate environment. Understand how different asset classes respond to interest rate changes. Position your portfolio to benefit from potential rate cuts. Consider refinancing personal debt while preparing for changing rate environments. Look at sectors historically strong during rate-cutting cycles like technology, utilities, and real estate. Build a bond ladder strategy that can benefit regardless of rate direction. Consider floating rate investments that adjust with changing interest environments. This possible strategy represents economic chess at the highest level. If rates are forced lower, it could trigger a massive market rebound and economic boost, just as the administration promises, while simultaneously making the national debt more manageable. Think of it this way. If you owed $36,500 on a credit card charging 10% interest, you'd pay $3,650 annually just in interest. If that rate dropped to 3%, your interest would fall to $1,095, saving you $2,555 every year. Now scale that up to trillions, and you understand the potential motivation. Let's quickly recap the major challenges we've covered and their potential solutions. The trade war problem. Escalating tariffs are disrupting global trade and increasing consumer prices. Solution: diversify across differently affected sectors and consider opportunities in domestic industries that benefit from reduced foreign competition. The NATO uncertainty problem. Questioning long-standing alliances creates geopolitical instability. Solution: build positions in safe haven assets and sectors that perform well during periods of international tension. The interest rate strategy. Problem or opportunity. Market volatility may be designed to force rate cuts. Solution: position your portfolio to benefit from potentially lower rates while maintaining enough diversification to protect against other scenarios. The common thread through all these solutions is preparation, not panic. Historical data shows that investors who stay disciplined during market turbulence almost always outperform those who make emotional decisions. There are several critical principles every investor must understand about navigating market crashes. Market psychology drives short-term movements. Most investors make decisions based on emotions, not logic. When stocks fall, fear dominates and people sell at the worst possible time. When markets recover, greed takes over and they buy at premium prices. This psychological cycle explains why approximately 80% of retail investors underperform the market over time. Dollar-cost averaging removes timing pressure. Nobody can perfectly time market bottoms. Investing fixed amounts regularly ensures you're buying more shares when prices are low and fewer when prices are high. During the 2008 financial crisis, investors who maintained regular contributions saw their portfolios recover much faster than those who stopped investing. Emergency funds prevent forced selling. No, Having 3 to 6 months of expenses in cash means you won't be forced to sell investments at low prices during emergencies. Approximately 40% of Americans can't cover a $400 emergency without selling assets or taking on debt, which devastates long-term wealth building. Market crashes create millionaires. Some of the greatest fortunes in history were built during economic downturns. The 2008 to 2009 market bottom created incredible buying opportunities, with many stocks delivering 1,000% plus returns over the following decade. Every major market crash in US history has eventually led to new all-time highs. Diversification is non-negotiable. Different asset classes respond differently to economic conditions. During the 2008 crisis, while stocks plummeted, US Treasury bonds actually gained value. In 2022's inflation-driven downturn, commodities outperformed both stocks and bonds. A properly diversified portfolio doesn't just reduce risk, it creates resilience. Imagine two investors. Both started with $10,000 in January 2020, just before the pandemic. The first investor, let's call them Investor Fear, panicked when the market dropped 35% in March 2020. They sold everything and waited on the sidelines until things felt safe again, which happened to be after the market had already recovered most of its losses. They then panic sold again during the 2022 downturn and the recent trade war-induced sell-off. Today, their account shows roughly $8,900, an 11% loss over 5 years. The second investor, Investor Discipline, did something different. When the market crashed in March 2020, they didn't just hold, they redirected some emergency fund money into the market at discounted prices. They continued their regular monthly investments through the ups and downs of 2022 and the recent volatility. Today, despite all the turmoil, their account has grown to approximately $17,300, a 73% gain. The difference wasn't luck. It wasn't superior market knowledge. It was simply understanding that market crashes aren't the end. They're opportunities disguised as disasters. Investor Discipline understood that behind the headlines and temporary chaos, businesses continue to innovate, grow, and generate value. This pattern has repeated throughout history. Those who surrender to fear consistently underperform those who maintain discipline and see downturns as sales on valuable assets. Market crashes aren't disasters. They're inevitable parts of the investment journey and often create the greatest opportunities for building wealth. The current market turbulence tied to trade policies, geopolitical tensions, and interest rate strategies presents both challenges and opportunities for prepared investors. Whether this downturn becomes a brief correction or something more significant depends largely on policy outcomes we can't control. What we can control is our response, choosing discipline over fear, strategy over emotion, and patience over panic. If you found value in this analysis, please hit that subscribe button and join our community of rational, long-term investors. Drop a comment sharing your own market crash strategy or any questions you have about positioning your portfolio during these volatile times. And if you know someone currently making panic-driven investment decisions, share this video. It might just save their financial future. Remember, in the world of investing, fortunes aren't just found, they're built deliberately and patiently, often during the very moments when others are running scared. I'll see you in the next video.